Welcome to the Upside Journal podcast. In 2026, domestic venture capital is struggling with extended exit timelines and dry powder gridlock. Yet, a sophisticated layer of cross-border diaspora business networks is quietly unlocking predictable, counter-cyclical returns. Today, we're breaking down the hidden alpha traditional funds are missing. We are looking at a literal masterclass in execution. We're going to deconstruct how a diaspora financial infrastructure company called LemFi managed to completely bypass the multi-year regulatory bottlenecks that choke most fintechs and instead built a dominant cross-border corridor. If you want to know how to scale a business in an environment completely bogged down by red tape, this execution playbook is exactly what you need. Let's dive in.
Listen to this powerful quote from December 2025. Janine Ross, LemFi's group head of compliance, lays out our core theme perfectly. She says, obtaining our own licenses is about trust just as much as it is compliance. You see, this perfectly highlights the VC paradox of 2026. While so many startups are still clinging to that fragile move fast and break things approach, LemFi adopted a highly disciplined execution model. They prioritized regulatory longevity over short-term growth hacks. Because in highly regulated industries, trust isn't some marketing gimmick you just slap on after finding product-market fit. It's the absolute entry ticket. It's a load-bearing structural requirement.
To understand how LemFi weaponized this concept, we're going to deconstruct their strategy into 5 parts. 1. Trust is the product. 2. The regulatory constraint. 3. Buying permission and expertise. 4. Sequencing trust and scale. And finally, 5. The operator playbook.
Okay, let's start with Section 1. Trust is the product. Baseline requirement.
The LemFi story really kicks off in 2020 with founders Ridwan Olalere and Ryan Cochran. These guys were senior operators who spotted a massive point of friction. Diaspora communities were trying to move money across borders and highly volatile currencies. Now, when your customers are immigrants sending essential livelihoods back home, we're not talking about casually splitting a dinner bill here. They absolutely cannot afford for that capital to disappear. In a category historically defined by unsafe, informal alternatives, proving absolute legitimacy to the customer isn't just a nice-to-have feature, it is the mandatory first step.
The crucial point here is exactly what CEO Ridwan Olalere pointed out during their Series A back in August 2023. Mainstream, traditional banks actively ignored this demographic. They steered clear of these volatile currencies. Because of that, immigrants were essentially forced into the shadows, right? They had to stitch together these informal, risky services just for basic financial needs. LemFi knew they had to build a fundamentally safe harbor.
Moving on to Section 2, the regulatory constraint, the authorization maze.
Cross-border finance does not have a single global rulebook. You don't just get approved once and suddenly operate everywhere. Every single new market demands a completely separate, grueling authorization process. Just look at their footprint over a 5-year period. It is staggering. They had to relentlessly re-earn their regulatory standing. In the UK, they secured an electronic money institution license via an entity called RightCard, which also got them an IMTO license in Nigeria. In Canada, a payment service provider license. By December 2025, they snagged 14 new state licenses in the US, and in Ireland, they grabbed an EEA-wide passporting right via Burrow Buttercrane. They literally turned a legal nightmare into an incredibly deep operational moat.
So what's the standard industry approach? File fresh, organic regulatory applications and just wait years, right? Aging gracefully while bureaucrats review your paperwork. LemFi said, yeah, no thanks. Their defining operational hack was a license-first M&A strategy. Instead of waiting in line, they consistently acquired companies that were already licensed. They instantly inherited that standing, completely bypassing the multi-year wait times.
Which brings us to Section 3, buying permission and expertise. Because when we look closer, this aggressive M&A strategy didn't just buy them the legal right to operate. It bought them crucial, deeply specific domain expertise. Listen to Ridwan Olalere in January 2025 regarding the Burrow Buttercrane deal. He explicitly stated, the acquisition was driven by our need to secure the right regulatory framework for our expansion. They weren't after tech or immediate profitability. They already had the core tech. What they needed was smooth, compliant operations across Europe. They literally bought an entire company to synthesize complex, multi-jurisdictional compliance mandates into a singular, seamless user experience.
This is what we call capability acquisition. A perfect example is their May 2025 purchase of Pillar.
Yes, Pillar gave them a UK Financial Conduct Authority credit license and 20,000 users, but critically, it gave them a highly specialized underwriting model built entirely for credit-invisible migrants. Trying to build that from scratch, that would have taken years. They bought the permission and they bought the exact functional capability they needed to secure their niche. Talk about an asymmetric information and talent advantage.
Section 4. Sequencing trust and scale. Trust before growth. Here is where we see their repeatable flywheel framework in action. LemFi didn't just throw everything at the wall to see what stuck. They meticulously staged their product rollout. Look at this growth timeline. By January 2025, they hit 1 million customers by focusing almost entirely on remittances. Master the basics first, right? Relentlessly optimize the user onboarding flow and settlement velocity. Once that trust was rock solid, they layered on credit with the Pillar acquisition in May 2025. Then, over a year later in July 2026, they acquired Wealth8 to add wealth management and investing.
And wow, did the strategy pay off. By the end of 2025, their customer count had doubled, hitting a staggering 2 million users. Building that flawless regulatory foundation early on directly enabled this massive, accelerated product scale later. They were compounding institutional trust with every single transaction.
Olalere framed this perfectly when announcing the Wealth8 deal. He noted, "We started LemFi by helping people send money because that was the most urgent need. But financial progress doesn't stop at the transfer. Establishing absolute trust through reliable remittances essentially unlocked their permission from the users themselves to handle their credit, their savings, and their long-term financial security."
Finally, Section 5, the Operator Playbook. Execution Framework. Let's distill these specific actions into generalizable lessons for any operator facing a highly regulated expansion. Step 1. Treat licensing as a growth lever, not just a compliance tax you're forced to pay. Step 2. Acquire capability, like underwriting models or active user bases, not just the legal permission. And Step 3. Let a top-tier jurisdiction signal trust for your brand. Securing Tier 1 licenses early, like LemFi designating London as its global HQ in 2026 and pledging £100 million to the UK economy, acts as its own incredibly powerful trust infrastructure.
Now, we do have to be clinical about the boundaries here. This is not a playbook for everyone. If you're a pre-seed startup, you simply cannot execute a multi-jurisdictional M&A strategy. Trust-building timelines are going to vary wildly depending on your category, and pulling this off requires top-tier institutional M&A execution skills.
To really underscore that capital requirement, just look at this number, $85 million. That includes a $33 million Series A and a $53 million Series B. That is the sheer amount of institutional capital required to execute this strategy. It takes serious liquidity management and dry powder to buy your way into immediate regulatory standing across multiple global markets. So, I want to leave you with this. If trust is a structural requirement in your industry, are you treating compliance merely as a tax to pay, or are you weaponizing it as a growth lever to pull? Capital has become highly commoditized, but the infrastructure to execute high-trust, cross-border deal flow is rare. To get ahead of these macro signals and access our premium investor network, subscribe to the Upside Journal and join our membership communities. See you in the next Daily Drop.